Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Stock sliding on valuation concerns. Lisa Shalett, CIO of Morgan Stanley Wealth Management, saying the following: while the 26 bull case remains intact, there are some headwinds from the affordability crisis and growing pessimism in the labour market. Lisa joins us now for more. Lisa, good morning.
Good morning.
It's good to see you. Not just about AI, not just about big tech.
It is not. It's about the K-shaped economy. It's about that consumer, the lower end of the K, and this idea that consumer sentiment, it's not even their behavior at the minute, it's this sentiment is so negative. You add to the question in the University of Michigan, what do you think job prospects are in a year, right? We're at the worst reading since 1980. Folks are really depressed about the potential for the job market, and it's not just cyclical. I think it is this hand-wringing about the secular story of Gen AI.
I think we've got to stay on that. 45 years of events. Just think about everything that's happened, GFC, the pandemic, and you, Mitch, is telling us, the consumers are telling us that this is the worst they've felt about the labour market across all those things that have happened.
Yes.
That's bonkers.
It is.
What do you think is behind that?
I think it really is this existential fear. I think it starts with what they're observing, as Lisa noted, with new graduates not being absorbed into the labor force at the normal rate, but what they're seeing at the workplace and all the visions of how I'm going to be automated away, whether it's from, the robotics end of it, right? If you're, a physical laborer or if you're a knowledge worker, from, an agenic entity or an agenic bot.
Do we have to have that kind of future where in some ways robots take over humans in order to justify valuations where they are?
I don't think so. Our take has been, here we are, there's 153 Americans working in the United States labor force. The U.S. Stock markets are the envy of the world. We're, within 2 to 3% of all-time highs. Our profit margins and our returns on equity are at historic highs. This is, as we were talking about before we got on air, some of this is the technology is here, and is this, a solution in search of the problem? I don't find a lot of people saying that America has a profitability problem.
Well, so Daniel Pinto of JPMorgan came out earlier this morning and was talking about this and said that there probably is a correction that has more to go, particularly with respect to AI, and said that in order to justify these valuations, you are considering a level of productivity that it will happen, but it may not happen as fast as the market is pricing in now. Is that how you see it as well, that there needs to be some sort of retracement, that potentially these are the stocks that could trade sideways for months, if not a year, before the use cases grow into some of the valuations?
I'm in that camp. I know some of my compatriots at Morgan Stanley are not. But, what's built into the 2026 earnings forecast already is about another 130 basis points of margin expansion and productivity gains. That is a lot of productivity gains in 1 year across an economy. And so our best guess is that, next year the earnings will be decent. And decent to me is up 5 to 10%. But things that, border on 15 to 20% is a push, because it's a level of productivity that I just don't think the American workforce is ready to deliver, let alone embrace.
Can U.S. stocks outperform if you don't have the AI names leading the charge?
I actually think that they can. And the reason is that I think that there have been huge portions of our market that have been squeezed out or forgotten, right, over the last 15 years by, this huge tech leadership. In fact, our best guess is that next year we're going to see some nice return in leadership to financial services as, we get deregulation and animal spirits returning to markets, healthcare, energy. So we do think that there are places to make money in this market, that new leadership can emerge or at least challenge some of these tech leaders. And that to me is a very healthy stock market.
Lisa, could you describe what's happening and what the starting point is going into 26? So we've seen a 3% decline at the index level on the S&P. How much damage is there beneath the surface away from big tech?
So there has been damage. Obviously, we've seen it, in some of the more macro sectors. We're seeing it in cryptocurrencies. Obviously, there's some pain. So we do think that there are opportunities. Like I said, we'd be picking through, some of the financial services stocks, some of these consumer stocks, some of the healthcare stocks have started to recover here. So there are lots of things to do.
What needs to go right with consumer discretionary into next year?
So I think the fundamental thing that needs to go right is that, some of our worries and the fears about both the job market and inflation need to kind of tamp down, and we need to see decent income growth for the bottom half of the K to quote unquote hang in there.
How much do we need rate cuts, significant rate cuts?
So it's an interesting question. I think, the small to mid-sized business sector, parts of private credit, I think need close to 200 basis points of rate cuts. The key thing is we're probably not going to get it. And that's why there's a little bit of this current dance that we're doing with the Fed, I think, which is kind of moot. It's like, what's the difference? Another 50 basis points? Who is that helping and who is it hurting? If anything, it's just kind of steepening the long end of the curve, which doesn't help your housing market.
Lisa Shalett, it's good to see you. As always, thank you. Lisa Shalett there, CIO of Morgan Stanley Wealth Management. 50 could do more harm than good.
Yeah, the idea that it steepens the curve and it leaves the mortgage market in even more pain. The idea that private credit needs 200 to perform highlights the gap right now in perception versus reality, and is part of what's fueling some of the angst that you're seeing reflected in equity shares.
You want to drop the front end aggressively. The balance sheet needs to do some work to cap the long end of the yield curve with inflation closer to 3 than 2.
You mean yield curve control is sort of the inevitability? That's what people think.
Maybe. I would love to get some insight on the interview questions.
We're monetizing the debt. Here we go, baby.
Is that what the dollar story? Is that what the dollar story was picking up on at the start of the year?
100%. I mean, Scott Bessent knows what he's doing. He's just going to jam it. He's going to buy it.
You expect another round of that next year? Another round of dollar weakness?
Yes, I do. Again, I know my compatriots at Morgan Stanley have moderated their view and said, they think the dollar's flat next year. But I do think we're going to have another bout of it, especially, no one's talking about this. But, Trump's throwing out there that, hey, I'm giving everyone the tariff bonus check. Well, weren't the tariffs over 10 years supposed to pay for your tax bill? Wasn't that the whole point? So let's see. You had a regressive tax. It's called tariffs. And now I'm giving you the rebate of the money I took from you?
I'm keeping track. I'm trying to keep track. Lisa, you keep bringing me back. I'm trying to go. It's good to see you. Thank you. Lisa Shalett of Morgan Stanley, everyone. Stay with us. More Bloomberg surveillance coming up after this. We need some more data, and we'll get that data on Thursday. Stephanie Roth of Wolfe Research looking for a solid 60,000 payrolls on Thursday's jobs report, writing the hawkish Fed narrative may persist through the report, but the narrative may change a bit with subsequent data that's likely to be more mixed. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Let's start with September. Why the bounce back? What are you looking for?
So we should see a bit of a bounce back in the sense that the trend over the summer was probably not the real trend. So we think not only will September be decent, but you also will probably get some upward revisions to August. So the 29,000 3-month average could easily look like something in the 60s. So that would be a much different trajectory because there was seasonality problems over the summer. There was significant tariff uncertainty. That has started to fade. The comment that you made about perhaps we're starting to see a bit of a pickup in terms of the job market in the month of October seems like a trend that we expect to persist in the next couple months, where you might start to see cyclical industries start to hire again.
So pair that with consumer confidence that's dead in the water, with people feeling really bad about their job opportunities, with the slow pace of hiring and wage growth, with the Chipotles of the world and the Sweet Greens and this morning the Home Depot. How do you square a story of accelerating growth with what we're hearing from companies and what we're hearing from consumers?
Well, this is growth turning at the margin. It's not as if growth is picking up to a very high pace. For 2026, we put out our outlook. We're looking for 2.1% growth, which is just above trend. And then at the margin, you're probably like to see the low-end consumer get a bit better. It's a price level problem, though. A lot of people feel bad about the level of prices in the economy, and that is a hard problem to solve because prices don't fall in the economy unless you have a large recession. So the administration is trying to put together policies that will bring down the level of prices, but that's just not realistic in this environment.
So this goes to a paper that you wrote recently about how Washington can't do this overnight in terms of the cost of living. What do you think then is going to be the solution? Do you think that it only can be driven by a recession, or that there are other marginal kind of efforts that could happen to bring down at least some of the inflation, if not the price level?
You're probably not going to bring down the price level. And certainly we shouldn't be hoping for a recession. So the best case scenario is that you grow into the price levels, in that you have a couple of years where wage growth is a little bit elevated. You start to see a bit of a pickup, call it a little above 4%, and then prices remain largely steady. So you don't really see a big pickup in prices and you kind of grow into the economy. At the same time, people then might forget about the prices as they were before the pandemic. I think that's part of the problem. People remember what prices were before the pandemic, and they don't necessarily take into account the fact that their incomes have grown about 29% since the pandemic as well, but they do see that prices have gone up pretty significantly since then.
Do you think that the risk then for the Federal Reserve is cutting rates could actually reaccelerate inflation in a way that goes counter to this?
Yeah, I think that is a risk, especially when you're talking about house prices is probably one of the areas that's the most unaffordable today. If you see a big reduction in rates, and if the government tries to put in place policies like the GSEs buying more MBS, and that lowers mortgage spreads, you might see prices start to pick up as a result, and that's a challenge. By the way, $2,000 stimulus checks, that would have the same result.
What is a big reduction in rates? Because some might argue we've had one, 150 basis points since September of last year, and housing and shelter costs aren't on the rise in a way that some people might anticipate. So what is a big cut to interest rates?
Well, I would say it's more a reduction in rates at the same time the economy is starting to pick up. The fall in rates that we've seen recently has been because the economy has slowed down. So
important distinction.
Exactly.
The jobs growth that you'd anticipate alongside with that growth, just describe 2026 for us. Because 2025 has actually been, people talk down growth for 2025. Growth hasn't been that bad in 2025. What's been bad is the employment growth. Why is 26 going to be different?
So it should be a little bit better. We're talking, our forecast is for 80,000 payrolls growth for next year. It's not as if it's anything compared to what we've seen in the last couple of years. But relative to break even, or the break even pace, our estimate for 26 is about 70,000. For 25, it was closer to 50,000. And the reason is because immigration was a lot stricter in 2025 than we expect for 26. Still should be strict, but less so at the margin. So we're talking about a payrolls number that's not that strong historically speaking, but better than it's been.
If you do see some sort of reduction in the tariffs, and we've seen some marginal types of moves around bananas and coffee and things of that nature, if there is a more significant rollback of certain tariffs, do you think that that would reaccelerate the economy in a more meaningful way?
Yeah, it certainly could. The challenge with that is also then you might start to see rates rise at the same time, because then you'll have an environment where people might be a little bit more concerned about the deficit, and at the same time you're just having natural growth acceleration. Fed cuts would have to get priced out. So that does pose some challenges, but I think there's the possibility that we'll see an environment where tariffs get rolled back marginally. But what we've seen recently is it was on some ag products. So I think what we'll see is the occasional tariff relief, but not enough to be needle moving in terms of the economy.
Can I ask you if your view changes with the incoming Fed chair? When you find out who the new Fed chair is, how much does that move the dial for you?
So our expectation is Hassett, even though we prefer Waller. If we end up getting someone like Hassett, I don't expect that the committee will change so much. It's a committee of people that are very divided at the moment, and that's likely to even grow if we have a chair that's seen as much more dovish than the rest of the committee.
We prefer Waller. It's interesting. I don't usually hear language like that from economists on Wall Street. Why would you prefer Waller, Governor Waller?
He's a much more independent thinker. He is very data driven. He's just somebody that the market very much respects, and I think that would be a good candidate given the sort of the list of
kind of implies that Kevin Hassett is not the NEC director. Is that fair?
That's fair.
What gives you that impression? Myron, their comments have been suggesting that
rates are a lot more, should be a lot less restrictive than they currently are. Their commentary is just much more in line with what the president wants to hear. And Waller is somebody that's been long respected by the market. He's had views that are very much data-driven. Yes, he's been more dovish recently, but it is backed by conversations around the labor market having slowed down, concerns around layoffs picking up, which is all very fair and solid arguments. I'm a little less concerned, but the market, I think, would very much cheer having him as the next chair.
Stay with us. More Bloomberg surveillance coming up after this. Amazon joining Meta, Alphabet, Oracle, all with multi-billion-dollar bond sales to help fund AI build-outs. Herr, the US global fixed income currency and commodities CIO at JPMorgan Asset Management, joins us now for more. Good morning. Good to see you.
Good morning, John. Glad to be here.
50-year debt from Alphabet, 40-year debt from Amazon. What are these guys up to, and why do investors want a piece of it?
So I think the first thing to remember is these are highly rated companies with a lot of free cash flow. If you think about the 5 hyperscalers, most of them have enough cash on the balance sheet to pay for this debt. It's the opportunity, though, to put debt in the markets. Yesterday, the investment-grade credit market had $26 billion of new issuance, all of which absorbed very easily. Initial price talk on the Amazon deal yesterday was, 25, 30 wider of a concession. It ended up pricing pretty much on the screws and traded there. So there's a lot of demand for fixed income here at these levels.
Even for 40-year tranches? I mean, what do you make of the 40 and the 50-year pieces of some of this debt?
Look, I think when you think about this, you're going out a long time, and the question about the returns that companies are going to generate for this, the AI investment, it's awfully uncertain. But I think these companies have a lot of cash flow. They can repay the debt. I think I would be more focused on the multiples that are paid in the equity markets than on their ability to repay when they've got cash on the balance sheets, Lisa.
The best way to say check your own house before accusing the debt markets of being
maybe
prolific.
So.
Yeah, you think that's what's going on?
That's right.
I just wonder if there's a better story to tell, maybe in either speculative grade credit or outside of the U.S., where you are more insulated from some of the tech story, because even if these are highly capitalized companies, the whipsaw in sentiment around AI seems to have driven a lot of the movement recently.
So I think if you look at the bond market's holding up okay. Look at yesterday or the last few days, you've had a sell-off. Bonds are actually doing what they're supposed to be doing, right? Think about it. The ag's up almost 7% this year. Bonds are delivering stability, diversification, liquidity. I know it's boring and old-fashioned, but that's kind of where we are.
Is that just a US bond story, or do you see that across sovereigns?
No, I think that is true more broadly. I'm obviously much more focused on the U.S., but I think broadly that is true. Bonds are doing what they're supposed to be doing here.
We've had a 40 basis point plus move on the year. I think on the US 10-year, we're down another 4 basis points this morning to about 4.1%. Some convulsions. I've used that word a few times in the last 24 hours with regards to fixed income. Some convulsions in JGBs. What's happening at the long end of the JGB curve, and what's the potential spillover into global markets?
So I think you've had some geopolitical uncertainty in the JGB. You've got a new prime minister out there, I'm on TV. You got to be careful what you say, because if you're going to use the word convulsions, people can make a lot of interpretations.
I use the word convulsion. You don't have to. Is there a potential, though, to re-anchor global bond yields higher, given what's developing in the Japanese bond market?
There's always a potential for higher. There's an equal potential for lower. I mean, every day there's a market made in this. I mean, look at the Fed, or look at pricing on the Fed. I think the last time I was here, it was almost 100% certainty that the Fed was going to cut another 25 basis points. Here we are. That's now below 50%. And so there's always a market to be made in these, and buyers and sellers.
Do you think the risk is balanced into that Fed decision?
I think the market is pricing it pretty much balanced. I think the probability is now below 50% today. But we actually think the Fed's going to continue. We think the Fed cuts again in December.
What's going to deliver that move? Another weak jobs report?
So it's funny. Yesterday, one of my trustees was in and reminded me that they always call us bond ghouls. We're bond ghouls. So bond ghouls, we can complain about anything. So we spent the 60-something days of the federal government shutdown complaining that there's no data, and now we're obsessing because there's data starting. We get ADP at 8:30. We get non-farm payrolls on Thursday. So I think if you look, the data is going to be anything you want it to be, right? We're going to get a September number number on Thursday. Consensus is 57,000 or whatever it is. But you all know that the margin of error for economists on those non-farm payrolls is plus or minus 100,000 jobs. So it's going to be interesting to see what the Fed does here.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to Capitol Hill. Affordability, top of mind in Washington. The Treasury Secretary Scott Bessent telling media that President Trump's plans for $2,000 tariff dividend checks will require an act of Congress. Anne-Marie is down in Washington, D.C. and stands by with a special guest. Morning, Anne-Marie.
Good morning, John. That's right. A man that potentially could be running hearings about this or will definitely get a vote on it. The chairman of Financial Services Committee, Congressman French Hill of Arkansas. Good morning, Congressman. Thank you so much for joining me.
Great to be with you. Thanks for having me.
So as Jonathan was saying, the Treasury Secretary over the weekend was talking about how Congress would have to act for these $2,000 tariff dividend checks the president has floated. Do you think that's something Congress would get on board with?
I think Congress would certainly consider it. I mean, my judgment has been that I think the tariff revenue that's sustainable, that people believe is sustainable in the years ahead, ought to be used to reduce the deficit. I think that would be a much better macro use of it. We are concerned about affordability in Congress. In fact, in our committee, we're going to have a hearing on housing affordability. How does federal policy, how could that encourage housing construction, development, and also improve affordability when we know the biggest barrier to housing affordability has been, first, unprecedented inflation, commenced by the Biden administration and the Fed's mistakes in and during and after the pandemic. But what can we do at the margin in federal policy to increase housing construction and affordability?
Well, I remember when the second round of checks went out to the Americans during COVID, the Republicans really made it part of their criticism of the Biden administration was that they were goosing inflation. Could $2,000 checks do the same next year under a Trump administration?
Look, I think inflation is caused by too many dollars chasing too few goods. And I think the origin of this inflation, a 40-year high of inflation that we had after the pandemic, was due to fiscal mistakes by the Biden administration, approving and spending another $6 trillion in federal spending that we borrowed. And secondly, by keeping rates too low and the balance sheet too big coming out of the pandemic. We're now healing from that. Inflation is down. Oil prices are down. I think the consumers are going to feel better off in their pocketbook from that. But we have to be wary that one of the biggest concerns that families have is the affordability of housing. And that's where I think we should tackle that at the federal level by removing barriers to more affordable housing and access to credit for housing.
Jonathan and Lisa were just talking about Home Depot earnings. They said that ongoing consumer sentiment has been a little bit weak. There's uncertainty there. Of course, Walmart's going to be reporting towards the end of the week. That's your constituent. Have you been hearing from Walmart and other either small businesses or big retailers about tariffs and how it has been difficult to pass on some of these costs?
Well, I haven't heard so much about, I've heard both about passing on costs for some small manufacturers. You know, American small manufacturers, our country is filled with that. And about 50% of manufacturing inputs for small business come from abroad, and 50% are sourced domestically. And there are some American manufacturers and small businesses that don't have another supply source. So they are hit in the short run by across-the-board tariffs, which is why generally I've not supported across-the-board tariffs. I think you ought to target countries for bad behavior, mercantilistic behavior, non-tariff barriers, negative tariffs towards the U.S. market, or target particular industries you think should come back in the supply chains, whether it's steel, aluminum, and then target that over a long period of time. So, yes, I've heard from my constituents about this, and this is why I think the biggest challenge is not so much the tariff rate as it is in the uncertainty about planning around tariffs. And I hope the administration can come to the decision that they've made tremendous trade successes with many of our partners around the world. Let's embrace those changes and get those implemented, and that will give certainty to people planning for 2026.
You're having your first hearing today since the government has been reopened, and it's about deposit insurance. So when I think of deposit insurance, I'm always reminded of the sign at the bank that says you are FDIC secured up to $250,000. What kind of changes could we see to that minimum?
Well, over the last couple of years, Congress has had some hearings hearings on deposit insurance about a couple of things. One, should the $250,000 level be raised? But due to inflation, it was last increased as a result of the 2008 crisis. Secondly, should we reauthorize the TAG program, which is an emergency program to guarantee transaction deposits in the face of a systemic problem with the U.S. banking system? That has been expired over the years, and so I think Congress should reconsider that and look at it. And then should we have a deposit insurance study at large about how deposit insurance is working for the American people? This is important. It's a priority for the committee, and it's a priority for the Senate Banking Committee, so we look forward to the discussion today.
How long would something like that take to actually do?
And what specifically?
Raising the $250,000.
Well, I think it could be raised according with inflation, but I think this is where I think a study and being data dependent is important. So many people make emotional decisions about finance. I think we ought to study, make sure we have the numbers, make sure we know the unintended consequences of any aspect of change of the deposit insurance system. You don't want to increase moral hazard. You want to maintain bank competitiveness for banks of all sizes. And that's important. And that's why I think we should take it in a deliberate way.
We talked about the kitchen table issues facing American families, what's going on in the banking sector. The headlines today, though, in Congress are going to be about this Jeffrey Epstein discharge position. How are you expecting to vote? And how do you think other Republicans will vote today?
I think people want transparency, and that's why Mike Johnson's done a good job, contrary to a lot of the mainstream media. Mike Johnson asked Jamie Comer, our Oversight Committee chair, to study this intensely, investigate it with subpoena authority, and he's released everything that's a DOJ or FBI-related document and the Epstein estate that can be legally released, meaning that's not covered by a court order not to release grand jury investigative material. The Massey proposal on the House floor that I think most Republicans and Democrats will support at the end of the day calls for releasing everything, irrespective of those court orders. So I think you'll see litigation. If this were to be passed by the Senate and it became a law, I think you'd see litigation about protecting the confidentiality in grand jury investigations, which is why I believe that the Comer approach and Speaker Johnson's approach was more deliberative and appropriate. But all, I think, Republicans and Democrats want transparency around the Epstein matter.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.